The move to 1.6 yesterday, did that catch your attention? And should it be seen as some type of harbinger of things to come, that there could be a rough patch in equities?
Well, look, when we see pretty substantial repricing when it comes to yields in the bond market, like we saw yesterday, it's no surprise that it has some impact in terms of the broader equity markets, because the rise happened relatively quickly and it causes the market to reprice expectations. And so, we've been in an environment where interest rates have been so low for so long. And if you're thinking about company earnings into the future, specifically with growth companies, if you start discounting that at a much higher interest rate, those future dated earnings, that potential earnings, ends up being worth a lot less today than it was, 6 or 12 months ago. So again, It's not surprising that we've seen some pressure on the equity markets given the rise in yield.
It's just math. We can figure that out. And you see that even though the prospects for the economy are probably pretty good as we reopen, therefore the prospects for the companies that we're talking about probably not damaged by 1.6 or 2%. But just the way that the stocks are valued could be where you go wrong, I guess.
That's correct. I mean, and again, there's a lot of stimulus that's already, been factored into the marketplace. The big question ends up being, does this package get passed, which most people expect that it will, and that's already priced in. And then the next question becomes, well, what happens in terms of, infrastructure? Is there going to be another large bill that ends up getting passed later on in the year that, again, could be supportive of the market valuations and things of that nature? But the thing to keep in mind is that when you look at equity market valuations, from our perspective, when you look at the U.S. market, it is relatively, we think it's slightly overvalued, not grossly overvalued, but slightly overvalued. And there are pockets where you look at growth stocks versus value, where value does look more attractive to us on a forward-looking basis. When you look at international stocks, that looks more attractive on a forward-looking basis as well. But there's been a lot of really good news that's already been priced in and reflected in asset prices.
If you needed to have a portfolio that wasn't, that could be protected from moves in equity prices, how would you hedge against that at this point if you needed to advise a pension plan or someone like that? And when would fixed income start, and what part of fixed income would be attractive?
Joe, we get that question all the time in terms of, the importance of still having, diversification in a portfolio. And, our view is that bonds still play a very vital role in a portfolio because it provides that ballast and that diversification. So when you get a big move in the equity markets, you get a downdraft, having that diversification from the bond side can help, mute some of that volatility. And that can help investors stay the course longer term. And the other thing that people have to remember, when it comes to, owning bonds, is that, look, ultimately, in the long run, if you have a long-term time horizon, rising interest rates are actually a good thing for you because you're reinvesting those principal payments, those coupon payments at higher yields, and that ultimately will produce a higher total return. But again, we always view and we always say to our investors that the importance of diversification, that principle never goes away.
Shepard Smith here. Thanks for watching CNBC on YouTube.